Imagine this. You think Canada's housing market is tough right now, but what if it's about to get even tougher? What if your plans to buy a home, rent, or invest are facing bigger obstacles than you realize? Today, we're breaking down why Canada's housing market seems to be crashing, and what it could mean for you. Right now, things are cooling off. The Canada Mortgage and Housing Corporation says home prices across Canada are expected to drop about 2% in 2025, with bigger declines in Ontario and British Columbia. At the same time, Royal Bank of Canada reports that home resale volume is projected to decline by around 3.5% this year, and prices nationally are mostly flat or slightly down. For everyday Canadians, this means the boom years are slowing, buyers have more power, and sellers may face challenges. So, why is this happening? First, mortgage rates are still high, making it harder for people to afford homes. Second, some provinces, especially BC and Ontario, have more listings and weaker buyer demand, creating regional pressure. Builders are also pulling back, with fewer new homes being constructed because of rising costs and caution in the market. Lastly, slower population growth and economic uncertainty are softening demand. All of these factors combined are cooling the market in a big way. Now, let's clarify what we mean by crashing. It doesn't mean prices are going to plummet 50% overnight. Nationally, prices may only drop a few percent, but some overheated markets could see bigger corrections. So when you hear market crashing, think slower growth, more supply, and weaker sales, not a total collapse everywhere. What does this mean for you? If you're buying, this could be a chance to negotiate better deals, but only if you can handle higher mortgage rates and regional variations. Sellers may need to adjust expectations, price homes carefully, and be ready for longer times on the market. Renters might see slightly eased pressure in some cities, as slower buying activity opens up availability. And investors should be cautious. Holding costs could rise, and returns may be lower than in previous years. To stay ahead, watch a few key things: mortgage renewals and interest rate changes, listings and sales volumes in your area, regional differences between provinces, changes in policy or immigration that affect demand, and the overall job market and economy. These indicators will show you whether things are getting better or worse in your area. In short, Canada's housing market is entering a weaker phase. Some regions will see corrections, some may slow down gradually, but the overall message is clear: it's not business as usual anymore. Being informed, careful, and prepared is more important than ever if you're buying, selling, or investing.